The broadcast is now starting. All attendees are in listen-only mode.
Hello everybody, welcome to Futures Analysis. This is the Bursa Malaysia Derivative Webinar Series, the 6th series on Futures Analysis. So in this webinar, you are going to learn how you can analyze futures from a technical perspective as well as the fundamental perspective. Alright, now as usual, this webinar is 90 minutes long. We allocate about 60 minutes for the content, while 30 minutes is allocated for Q&A. I want to take an opportunity to thank all of you for coming here on time. Now, if you can hear me clearly, could you please go to the control panel and click raise the hand button? If you can hear me, please click the raise the hand button. All right, excellent. You may put down your hands now. Thank you so much. My name is Shane. I will be the moderator for this session. So, disclaimer, now whatever we share in this webinar is only for educational purpose only. As usual, Bursa Malaysia nor the speaker or the moderator accept any liability for any information provided or your trading decisions. So if you decide to trade or long or short any contract out of the discussion today, you do it at your own risk. Is that okay? All right, excellent. Now, as you know, this is the last webinar for this Bursa Malaysia Derivative Webinar Series. We are at the 6th webinar, Futures Analysis, and after this, we would start planning for the next year webinar. So when the next year webinar is out, you will be the first person to be notified of the next year webinar. Now, I'm very honored to be able to invite a speaker today, which he is a full-time futures trader, and if you attended our previous few webinar, you have seen him twice already. This is the third time that he speaks for us, and he is very experienced. He, in fact, is a local participant. For you to achieve a local participant status in Bursa Malaysia Derivative, I think you need to trade at least 1,000 contracts per month. Okay, that is incredible. So he has a lot of experience in it, and he is full-time. Okay, every day morning, wake up and then trade futures until sunset, still trading futures. Okay, now he's founder of Straight Index, never had a proprietary trading company and associate participant of BMD. He's a trader, trainer, and a writer. He writes regularly for many columns, and he's a speaker for SIDC, CPE, and program at various financial institutions. Okay, he's a columnist of Singchu United Daily, Money Compass for more than 10 years. So, CC is very glad to have you here on the line with us.
Hi, Shane.
Yeah, thank you
The
so
pleasure
much
is
for joining
mine.
us. All right, so now, are you ready? I'm going to pass
Yes,
over the control to you.
Okay.
Okay, excellent. So I'm making you a presenter now. Okay, then you can share your slide already.
All right. Let me share the screen.
Yes, I'm seeing your screen now, but what I'm seeing is a presenter view of your screen.
So is it okay now?
Yeah, this is correct. All right, take it over.
Okay. Hi, everyone. So thanks, Shane. So we begin with tonight, the webinar tonight. About how to analyze. Before you start trading, you need to have a view. How to trade. Whether you're actually going for a long position or short position. So that's something that you need to do before you start trading. Basically, there's two group of methodology that normally people will adopt. So first will be the technical, and second will be fundamental. It used to be fundamental is the factor of analysis. That means you need to know anything about the market. You need to know whether the market should go up or down. So usually we will be actually using fundamental. But then I think like maybe 30 years ago, technical analysis has overtook fundamental as the primary type of analysis before you make a decision to trade. And then it happens to that. Let's say I give you an example. Last time, all the physical trader of palm oil, for example. Malaysia, the star product of BMD is actually palm oil contracts, FCPO. We used to actually, before I started palm oil, I thought, one day you need to know the price of the FCPO, which is the crude palm oil futures. You need to look at the physical price. But after I traded for some time, I asked people who trade physical palm oil, which they really import and export crude palm oil. What they do is they actually look at the BMD futures price. So before they decide how much they set their physical price. So that actually give me a shock that, instead of people discover price by looking at the export and import price, but traders are nowadays look at the futures contracts price to discover the correct price for the physical. So this is actually a huge blow of mind to me. So that means the aspect of looking at price will be on the futures contract that traded. But then the futures contract that traded actually is solely, it's not fundamental purely anymore, because there's speculation, there's hedging, there's so many things going on in terms of the price up or down. We call it the price discovery. So the price always try to discover where is best price or the correct price or the fair value of the underlying asset. So in order to analyze all this, you need to know too much information. So, but after sometimes the technicians has discovered that actually you can look at some patterns, some repeating formats or patterns that you can actually roughly know where the price is actually going on. So, or before the trend started, there are some signs, accumulation stage and all this. So that is the time when technical took over fundamental as the ultimate price discovery element or factor. So nowadays, most of the traders or investors, they look at technical as one of their main source of future price discovery. I remember, like some 20 years ago when I started the company, we teach some, technical charting and all this. Those are the time people are start picking up technical as the main source of, price discovery. But then after some time, this analysis has so matured that nowadays you can actually, start YouTube. Okay, you can watch all these technical terms, how people talk about trading and all this. Even through internet, you can actually learn from it. Today's webinar is one of the example. Of course, today I'll be focused on the technical and the fundamental. But then most of the time, traders are still look at technical factor. But I will also talk about something that not really a technical or in between the technical and fundamental, where you strike a balance how we actually trading, because purely based on technical analysis maybe not going to be last forever as well, because things keep on changing. 20 years ago, if you are good in technical analysis, you're very good, because those are time you really is pioneer. But then 20 years down the road, technical analysis become just another type of like last time fundamental, people just look at fundamental alone. Nowadays we talk about algo, we talk about computer trading, we talk about how to backtest 10 years 20 years data. People has all sort of technical tools to actually analyze this technical analysis. So let's move on, just a brief introduction on how these things started and what is a theory. So once you understand all the methodology and theory behind it, then you can choose your correct path, which how to lead you to a successful trading. Okay, so slide number one, the principle of technical analysis actually is important today, and it's to provide a systematical representation of market direction with all the statistics. Actually, I'm trading with statistics. All right. So technical charting is actually a statistic tool which they plot in charts instead of figures. And these analysts or technicians knows the futures is actually unpredictable, but you can actually prepare. So even though you know technical analysis, doesn't mean that you actually can predict the future. Because if you think that you can predicting the future and you're correct probably 10 times for the last 10 trades, actually it's very dangerous if you thought you can actually predict the future. But if you think that technical charting or technical analysis is merely a tool for you to prepare what will likely to happen next, then you are actually in the correct mindset to become a trader. That is my my view on how this thing should be looked into from today market point of view. So there's a few principles that you need to understand first before you really go into technical analysis. First is the market actually prices in such a way it discounts everything. That means everything that affect the prices is already in the prices. That's what it means, okay? And then price moves in a trend. That means when there's a trend going up, it should be able to continue to go up, for some time. The trend will not going to stop just because of some counter trend and all this, okay? And thirdly is history repeats by itself. So these three major principles actually can shape, or if you can understand these three principles, roughly you have the idea how this thing will go. All right. So I'll give you an example on the price discounts everything. Okay, this is a CPU or crude palm oil chart. So you see that actually the price actually break below the 200-day MA. Okay, so the next moment, the price trying to actually recover from this resistance, which is the 200-day MA, but then unsuccessfully. So that is a different definition in technical analysis, which if any price drop below 200-day MA or EMA, doesn't matter. So it's actually roughly the price has been below 1 year average. So any price below 1 year average can be considered as a long-term bear run. So the market is actually not easy to break above this resistance. So with this kind of mindset, you can actually, almost where the market can go. So the market can very likely to actually go even deeper or lower because the resistance are intact. So that is where it goes. Of course, the fundamental issue behind this price or the crude palm oil price are below the average is because those time CPU end stock has hit the all-time high, so that because of overstock, oversupply, so the price cannot go any higher. So instead, the price actually come down even more. So that is what behind the actual price action. But the price action has reflected anything in the physical on the fundamental market, which oversupply market has occurred. So that's why the price below 200 in MA and going down. So that is the whole point of the price actually discounts everything. In fact, any data before it's already most likely reflected on the price. So anything you see in the market, or that's why sometimes you may be actually shocked why a bad news comes out, the price can actually go up instead of coming down, because the price already down because of anticipating the bad news. But once the bad news actually came out, the bad news is actually not as bad as we predicted, or the bad news is there already. So we look for what is next. So we know that a lot of people oversold. So that's why the price actually due to rebound. So that's the reason why it go up. So you shorted, then the price go up, or you sold, the price go up. You may say that it doesn't make sense, but actually that is what really happened, because price has discounts everything. Price goes up for a reason. You may think that it could be some manipulation, but it's actually, if it's regulated market, it's so difficult for you to manipulate, especially when the volume traded is actually quite big. So it's not easy to manipulate the market. Okay, move on to the next slide. Okay, there are some basic chart patterns, that you can actually recognize by doing technical analysis. For example, this is one of the example. You can see that price go up and down and all this, but actually this is what happens by recognizing all these patterns. You actually can sort of like you know where the trend will go. So first you see that the price actually discounts everything. Second, you see that as long as there's a downtrend, the price will actually continue to move. So thirdly, you can actually see some repeating format. You can actually try to find the price break below 200-day MA, or the price actually form a head and shoulders pattern. So of course there's a lot of patterns that involve. We talk a bit on that. I'm sure some of you may have actually learned all this reading book, or most likely watching YouTube. I remember last time we used to buy a lot of books to read this kind of pattern and try the explanation by reading the book. But nowadays you can really find very good source to check out what are the pattern means. There even has got a lot of YouTuber which will explain to you, which is very good. The way pick up or learning things are actually become very, very fast. So I'm trying to actually cover the parts that is missing there, besides some basic ideas, and the important things that are going to actually share with you are the how actually to interpret and how not to over interpret or optimize to this. So before that, of course, I cover a bit very basic thing, but it's actually important. That's what I read most of the time is the chart type. What type of chart we read, or we look at the chart. So there's few important type of chart, which is bar chart, candlesticks, and Heikin Ashi. Bar chart has been there probably 30 years ago, but nowadays not many people are reading bar chart. But I show the bar chart because I want to, in case you have never come across this, you may actually need something to actually understand the basic. So the basic is actually, well, the open price, you mark a price of open, and then you mark the price of the closing price, and a day high and day lower. So that way you actually can see one candle bar, or sorry, it's one bar chart actually appear, which actually indicating where is the open and high for the particular time frame. In this chart, let's say for example, it's a daily bar, which is 1 day. And then another bar on the right hand side is actually open price. So where the price open at this level and then close, sorry, before it go down, it's actually maybe hit a day high. This is a day high by price, and go to a very low, lowest point of the day, we call a day low, and close. So if you understand this, just a very basic, marking of 4 prices. We call open, high, low, close, 4 prices. Okay, you plot in one bar or one stick. Okay, so from this bar, but for the Asian country, and nowadays more popular chart patterns will be the candlestick pattern, which is actually exactly same as the bar, but instead of using 2 sticks, now you can actually have the ability to plot a candle bar, which you can see on the left hand side is green, and then the right hand side is a red bar. In Malaysia, we use a green bar, indicating the price actually go up, just like the Western country. So the price open at this level, okay, and then later it's actually go up higher, okay, and close at this level. And these 2 shadow is actually the high and low of the price. Okay, the other one is actually just the opposite. The open price is actually high, and then there's a day high price there, and the price actually go to a day low and close at this level. It forms a pattern which is looks like candlesticks or candle, so that's why the name is actually a candlestick. Okay, so yeah, from here we can actually see that once you have all this in place, you can have something to call a chart type. You select this. Nowadays you can just use a mouse to click or choose what pattern that you are looking at. Now move on to the next slide. There are some common type of pattern that you can find in your chart. You can at the everyday chart that you're looking at. So namely, I just name a few that maybe you may or may not be aware, but these are how the pattern look at, and that's how it names. So you can always find out more. There's hundreds of patterns available. Let me explain to you briefly. The name of spinning top actually because it looks like a small body with short shadow. So that's how or why we call spinning top. But this spinning top doesn't mean that the price actually move very big. It means that the price actually move quite tight range. But usually it marks either a small volatility day, or it's actually a day that could be a sideways. The price just not moving a lot. We just call it a small candle bar. So usually, but we don't look it lightly. But you look at it as okay. Today the sentiment of it is the market may be quiet, or the market may be indecisive. It doesn't know where to go. That's why it forms a very small candle. But of course, when you actually trying to explain a lot of explanation into this chart pattern, you develop a lot of analysis. So by combining all these patterns, you form a so-called perspection. Okay, when this form comes out, the most likely pattern will be next. It will be reverse of the trend. That's how this analysis is developed by through experience and all this. But of course, you don't have to go through all this experience. You just have to read and remember all these patterns. I have few patterns available in the slides just to inspire you. This thing can go on with this way. Okay, for example, this is a hammer. Okay, you can look at it looks like a hammer definitely, so that's why I call it hammer. One is actually upright hammer. The other one is actually inverted hammer. The green bar means the price is actually closed higher than the previous day, and the red bar usually means that close lower. If you read this black and white color, it will be black color for the red bar. But please be reminded, if you look at any software probably from the China, the red means go up and the green means coming down. So it has got a reverse meaning, if you look at China's kind of software. Another type is actually a gravestone. The name not nice, right? So and dragonfly, just two type of pattern which looks like the natural form of these two elements. So the next thing probably very popular called Doji. Okay, it is a cross. So it means that the price open and close at the same price. This is very interesting. It may go slightly higher and lower, but the price close exactly as the opening price. So this actually the technician has find that it's actually always give you an indication the price has meet equilibrium point where the buy and sell or the demand and supply has come to a equal point where the price, the buyer is equal to the seller. So usually this marks a point where the reversal point for the price. Let's say if the price going up, for example, this is a going up trend. Okay, when you see this small body, so it means that the buyer has actually exhausted and there's more seller willing to start selling, and they meet center point, neutral point, which they become balanced. And usually it marks as the next stage, which is actually distribution stage where people start selling because of more seller coming up. But to do this, you have to be very careful. No one is actually very 100% confident. Once you see this pattern, the next must be that. But there's always some chance you could be wrong. For me, I always say that the analysis or anything that I've done to commit to a trade, I could be wrong about 25% of the time. Even I want it to be 100%. It could be 50% would be you don't analyze at all. You just go in blindly. So, and I actually quite comfortable if the trade go on with 25% so-called losing end. In fact, I almost design my trading to be it fail 25% of time, because if you fail 25% of the time, it looks bad, but actually you actually gain 75% or you correct 75% of the time, which means you have very good system. Now look at this pattern again. So a small body usually indicates the price may be reversed. The small body can be also a Gravestone doji. So it's actually combination of this. The next one will be a small body candle. It called Evening Star. The names looks good. It gives you how to remember. In fact, I can't really remember all the pattern names anymore. But I know what it means. But I also know that the traps or the disadvantages of using this, because you can never be sure this could be 100% sure what will happen next. It actually gives you anything above 50% is actually considered good. 75% is even better. So that's where okay, technical analysis and my point of I always say in my slide is a trader notes. That means it's just a note that to myself or to you from a trader myself. So the next one will be very similar again. You see, all the pattern actually is the same, but different name, right? So it's a shooting star. Shooting star means you have a very long upper shadow, which also point to the price actually may reverse because it go up but doesn't able to sustain, and the price actually close at the lower part of the day. So it's normally actually marked where the price actually could meet the highest point and will reverse. So this is only how it actually gives you the idea how this technical charting is formed actually. So the next one will be using all the similar things. You just copy and reverse the chart. You can see a hammer. It's reversal from a downtrend to up, uptrend. And then you can see this is another pattern, which a morning Doji Star. So it's actually all this reverse of pattern, which gives you a reverse meaning. So with this kind of charting, you can actually have a so-called better idea of how possible or potentially the price direction. It may sound so bad when I say it doesn't guarantee you the price must go there, but because of a lot of errors and because of a lot of imperfection, so technician has actually improved candlestick or even the bar charts and all this to a chart called Heikin Ashi. So which brings me to this kind of this charting. Okay, Heikin Ashi is actually a candlestick chart, but it gives a slightly modification. I have all the formulas later on for you. Okay, it gives you a slightly different way of reading chart, whole new idea basically. So instead of remembering all this pattern, it has got a shortcut. Okay, what's the shortcut? Okay, the shortcut is if you look at a lot of black bars. Okay, for example, this, then the next anticipation or prediction or forecast will be if you look at 3 or 4 black bars, most likely the market will form even more black bars. The black bars usually means the price closed lower than the previous day, so it means down. Okay, so you can see the first black trend. Okay, the next trend you can see normally 3 black bars. So most likely you will see more and more black bars. Even the price go up a bit, you can still see a black bars. That means the price has a likelihood of going down. So here another example. Before that, there's only four black bars, but it doesn't go down. So there is some imperfection of this indicator as well. But usually when we see about 3-4 bars, 3 bars are usually I want to use it. So then the next trend most likely is actually having a downtrend from this Heikin Ashi. I copied this from Investopedia. This is a formula where you can see the close price of this candlestick or this Heikin Ashi candle is no longer the close price. The close price actually is the average of the 4 prices we said just now. The open, high, and low and close divided by 4 means it's the average price of the current bar. So instead of the close price alone, now it becomes the average price of all the prices. And the open price is no longer just merely the first price of the day. It's actually a previous open price and the previous close price divided by 2, which means the open price is the price always open at the midpoint of previous bar. Okay, never mind the meaning actually, because you should actually always look at what I mentioned just now. If you see a 3 black bar, usually the trend is going down. If you see a 3 white bar, so the trend is going up. You see, most of the trading we talk about is directional or a trend. Recently, I've met a trader. He actually mentioned to me the price of palm oil has been whipsaw, sideways for some time. So that's why he find that it's very difficult to trade. So that's why he actually stopped trading for a while. And most traders definitely will look for trend, because trend is the time the easiest to make money. Remember, stock has been bull run for probably 6-7 years for the past 10 years. So those are the times that easier for you to trade, because you need to only follow the direction of the major trend, because the trends go up, so you just buy. But if you trade long enough, you know that any trend will eventually end. So what if you catch the last point of the trend? So you buy, the price come down. So in order to avoid this, you have to be very careful. You could be wrong, and catch the last trend, and the trend is actually going in reverse anyway. So you have to be careful on this. So in order to filter all this, you need to have a lot of in fact, you need to have a lot of doubt in your trading. That means you cannot be so confident. Doesn't mean that I have done 100 steps of analysis before I go in this trade, and this trade should be very safe. I don't think anybody can guarantee this kind of method. But you see, if you have prepared, if I'm wrong to go in this trade, what will happen if it is go wrong? But what is the steps that I need to take if this trade goes wrong? Then you're actually well prepared. But if you prepared so well analysis before you go in the trade, then it doesn't mean that guarantee you can get out alive. So a lot of traders will be trying to catch the trend. The trend is difficult to catch, because it doesn't mean that it's actually difficult by nature, because the market will sideways first before it go up. So whenever it go up, you think that it's actually you buy, but the price come down again. So it's actually still in the whipsaw or sideways. So this bar or this Heikin Ashi trying to solve this problem by using average. That means instead of you read moving average alone, you read the average bar, the price or the candlestick in using average prices. So there you go. High, you're not going to use the highest point, but you're using the maximum of either high, open, or close. So either using excuse me, one of the highest price, and then you'll be looking at another element, which is the low. The low no longer using the low, but you use a minimum value of the 3 element as well. So that's how this Heikin Ashi is actually formed. Take a look this fact. It's actually Heikin Ashi has been derived from the Japanese candlestick, which we discussed earlier. But it just use different set of data and calculation. And the result is actually this candlestick pattern, or the Heikin Ashi, has filtered out some of the noises in the effort of better capture a trend. Again, it's actually trying to capturing a trend. And Heikin Ashi represent the average price of, or average pace, or average speed of the prices. So that's how it's actually slightly different. And a lot of bullish and bearish reversal pattern that you use, like just now when we talk about Doji, when we talk about hammer, it's no longer applicable, because it go to, you need few bars to actually interpret this. So the good thing is you get a better picture of trend. The bad thing is actually you need 2-3 days to confirm. So that's why sometimes you may be not the first one will enter into the market. You could be the number 6 or 7 person, or even the 4th person to go into the market. And this Heikin Ashi is used to identify trending periods, which potential reverse point and all the classic technical analysis pattern. It is still applicable and useful as what you learn. I will highly recommend, if you're doing this, you could have a higher successful rate in terms of identifying or confirming a trend by looking at chart. So that means indirectly, I'm giving you a shortcut. Instead of learn all these patterns or candles and price action, you can actually slightly give a focus on the Heikin Ashi, which gives you a better trend indication by the price action, and it's quite useful. I've been using this for a while. So you don't have to remember all the pattern anymore. So this is actually a good way to get started. Of course, if you're very good in remembering all the candlestick chart patterns and their names and their result and their forecast elements and the story behind it, you could still use it. But the Heikin Ashi is just another form of pattern that you could explore and use it for your advantage. So I am giving you some example here on how this Heikin Ashi works in a real example. So this is a CPO chart. Okay, CPO chart. You look at here. There's a lot of candle, one white, two, black. What it means. So it could be mean a lot of things, right? But if you change this chart to a different pattern or candlestick using Heikin Ashi, this is the result. Okay, this is a Heikin Ashi chart. You see, compared to the previous one, the Heikin Ashi actually gives you a very clear color indication where the price is actually could be going down, because you see more black bars than a white one. So this is how the Heikin Ashi works actually. So you just merely look at the prices, the colors and the pattern, roughly you know where potentially the price will go. So another example, okay, you can see a lot of bars, going on, but you can never show that, 3 black or white bars in candlestick alone. Does it mean that the price go up or down? But by looking at Heikin Ashi, it gives you a totally different perspective. The price could go up or could go down by just looking at how many bars is black, how many bars is actually white. So this is a new way, just to look at chart pattern or chart type. So another example is this is a spread chart. Okay, if you have not encountered spread before, this is maybe one of the best thing to do it is look at the spread chart. The spread chart is merely 2 contracts. You can look at the screen here is a calendar spread of December and January. So you combine these 2 contracts, you get a spread chart. So if you've been trading in CPO, you will actually encounter not only you can trade option of the CPO, not only you can trade the CPO inside the futures contract, you can also trade a contract called spread, so which you can find in your course, or you can actually check out with your broker. Okay, but you looking at the same chart, it applies to the same Heikin Ashi. You can see a slightly clearer trend, how you could actually identify the trend. Okay, this is how future analysis has been designed and Tension has been using. All right, so after the trade, all these patterns and candlestick type or bar type, let's look at support and resistance. Trading, you always look at the support and resistance, right? So the support, it will be all the price has been supported and it never break below it, so normally we name it support. The resistance is just another opposite. Okay, so it's I call it discretionary idea of trader or analyst. So usually it's actually you connect multiple low and high, and if you see how this thing interacts with the price of future prices, so this form potential support, which is lows obviously, or resistance highs, which gives you an idea of where to forecast the market. Let we see the example. So you can forecast this by extending the trend line, so that every time it hits, you know that whether it's support or resistance. So I give you an example in support. Okay, you can see that the price has been hitting very low price at 39 cents for some time. So this we call support. So whenever the price doesn't fall below this, so you call it supported. So you should be actually plan to buy at a support level. If you see that the price is actually potentially you have the upside, you should actually able to buy at this level. Usually what I do will be I park my order there in the low price and hoping that it will fill my price and consolidate a bit, maybe then it go up. So that's how you can actually trade with a support, which is a very important idea which I use every day without consciously that I know this is price. I normally remember last time I bought this price, it doesn't go below and I make money. So usually it marks a low price. But in the chart, of course, you can see this as well. And then on the contrary, resistance. So same thing you can see from this chart is that if the price doesn't go beyond this price for numerous of time, it means that this is a resistance. That means the price cannot break new high from this point. Usually it's a resistance and you should actually avoid buying it, and you should be actually start selling it. And if you're trading futures, just short sell this price. And combine all this, you can see that support and resistance idea is there. By knowing how to join this high and lows, you can actually form something called chart patterns. So the trend lines will form chart patterns with the knowledge of skill, trend drawing and all this. So and a technician or analyst could actually further develop the skill to identify this, common pattern. Remember I said history repeats itself. The chart pattern actually repeats by itself as well. So look at some pattern available here. For example, there will be a triangles, there will be wedges, flags, pennants, double top. A lot of names of the pattern that you can find in technical analysis, which we cannot cover all here. You can actually see the idea. But if, for example, I give you a tip. If you look at resistance and support level, it's actually all the chart pattern is just at different angles of support and resistance. So any breakout is a trading signal, any support is a trading signal by itself. So if you understand this, you don't have to remember the name anymore. Just try to draw the trend lines, and price cannot break the trend lines, should actually stay, cannot break out, and vice versa. So this is how a simple way of looking at chart pattern and from the trend line and support and resistance point of view. Move to the next slide. We'll be talking about some common indicator from technical analysis, but there are so many. I don't know whether it's hundreds, how many hundreds of technical indicators. There are moving averages, Fibonacci retracement, Bollinger Band, stochastic, and so on. Instead of I tell you one by one, it's going to take years to complete. You can always test with this indicator, but don't test with your eyes. If you have the time, you should actually try to test this with a computer, so that you try to use whether moving average will give you a good buy or sell signal, or a Fibonacci will give you a good buy or sell signal by using software. So I'll certainly talk about this software probably later on. But before you really use all these indicators as your, has been so many years I've been trading. I heard so many people have been saying, oh, I use this indicator is best, or I created this indicator because this indicator give me very good return and result. But is it give you very good return for the past 10 years, or but by the past 10 years by computer test is totally a different angle to me. To me, my job is actually trading, so I'm actually basically trading for a living. So my salary is actually derived from my trading. So I need to make sure that if I'm trading with this method, I have to make sure I get paid for the next month, right? So because I have to draw salary from my result of the trading. So if my result of trading is actually losing money, I can't draw salary out of it. So that's why it's important not to fall into the traps of indicator. My opinion, I have actually set 4 types of traps in indicator is so instead of I actually ask you to try all these indicators, you have to be careful when you actually choosing indicators, because it will have these traps called collinear effects, confirmation bias, over optimize, and curve fitting. Let's talk about collinear effects. If you say that this indicator is better than the other one, it's actually, if you study correctly, if you do a very good statistics, most of the indicator will almost give you identical signal all the time, or most of the time. So actually, it's very hard for you to find a good indicator for a good particular good instrument. Sometimes this indicator may perform better than the other one, but it doesn't mean that all the time this indicator can perform better and cannot be replaced by the other indicator. How to test this is, to test this you have to use probably MACD, stochastic, RSI, and test with the computer software using the same data but different indicator. Does that give you a similar result? And surprise, it could actually give you a very similar result by using different indicator if you use a very long time frame. So that's why do not succumb to the the traps that using one indicator can be better than the other one. So because there's a correlational effect. And confirmation bias. Confirmation bias is actually something that you look at the chart and try to do a back test. Let's say you look at back 10 years ago using your eye to see that this indicator will give you a very good signal. Then you fast forward 1, 2 months, 3 months, this indicator give you a very good result again. And you fast forward 3, 4 months, give you a very good result again and again. After some 10 years, you conclude that this indicator is the best indicator because it gives you a very, very good result. But in reality, it's actually just a confirmation bias, which means you are looking at some signal that you wanted to. It means you are actually telling yourself to look for what type of signal, because by looking at eye, you see our brain is very sophisticated. You can actually create something that doesn't happen or doesn't exist as what actually form is, but your brain may be thinking that this is a very good indicator because of every time I go in with this kind of signal, I make money. But if only you know the future, because you know the future, you know the whole past year 10 years data, that's why you know how to trade. But if you look at something that unknown totally, you practice this, you cannot get a very good result because of confirmation bias traps. Okay, so you have to be very, 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 very careful not to succumb into this trap. Third is over optimized. That means you've been using more than probably 5, 10 indicators. So if you have a way to trade, like first, if this indicator give you a good signal, yes. Second indicator could also give you a good signal. Third, fourth, and number 10 give you a very good signal. Then it should be a very good trade because all the indicators giving you same result. Or out of 10, 8 are giving you go. You should buy, then you buy. It actually, it sounds so good. In fact, I think 20 years ago, I tried to develop something like this, and I realized I actually cannot. So how I realized this, because it called over optimize. You try to build something so perfect. It gives you a signal, you go in, it doesn't guarantee you make money, or it doesn't guarantee you to trade enough of trades. You may be actually trade only 1 or 2 trades per year, but that's actually doesn't actually give you very good result in long run, because you may actually miss all the trade because you may not able to go in because you're so optimized. You're so over optimized actually. So try not to over optimize by using too many indicators, because again, the first element is correlational effect. It's actually everything giving you the same result actually eventually. And the last is curve fitting. Of course, curve fitting is another way we call confirmation bias. But confirmation bias is you look at the chart by your eye. Manually, you go back 10 years and you just slowly you go in one by one and all this. Curve fitting could be much worse because you're using computer software to curve fit. Confirmation bias is actually curve fit as well. Curve fitting is actually you assume the history will, the price action, the history will repeat exactly like what happened before. Then you're actually expecting something that history repeats itself. History does repeat by itself, but it's not 100%. So you have to be careful not to fall into all these traps when you are actually trading. So with that, we go into another angle. Just now I mentioned to you, you should actually test your indicator. You should avoid to use your eyes to go back 10 years, and do the back test by your eyes and your mouse to click for the past 10 years. You should use a software to back test, because the software will actually not honor to your perspective. That means you don't use your eyes and brain to beautify all the entry signal. You use a very straightforward agree method. That means every time you see the signal, you go in. Every time you see the signal, you go out, you get out. So by testing with a real life example, you realize that you actually almost impossible to catch the trend every time. Even you have a very good trend indicator, even you wanted to trade, everybody knows that trend is actually best friend. If you catch the correct trend, you can make money for enough for 10 years. But then the problem is, does you able to catch the trend? Because before a trend start, the market will sideways whipsaw, many times. Every time it looks like go up, then it come back. Every time it looks like go up, it come back. So we call this whipsaw or sideways. So whenever this happens, but your signal tells you every time this indication or this kind of setup or combination of indicators is where the price will go up. So if you look at this kind of signal appear, you should go in. But then every time you go in, you lose money. You go in, price come down. You go in, price come down. So after 10 times or 7 times, do you follow the number 11 signal? But the 11 signal that you don't follow, that is the one that actually go up all the way. And there you go. This is the signal that you may actually miss, and the signal that you supposed to actually take it. So by using a software to test, it shows you this kind of flaw in your system. By using your manual way to do the back test, it doesn't have this kind of flaw, because your eye and your brain try to perfect the signal that you try to look for. So to avoid this, use software to do a test. I'm showing you one of the software is available freely to all the trader. Okay, it called Ninja Trader. You can just Google it, Ninja Trader. You can get the software, use put in data and do a test. If you don't know programming, this is fine. You can use just mouse to drag and drop some indicators. Of course, I'm not selling the software because software is free. That's how I get started to test all this indicator and come up with all this kind of conclusion. So you can actually optimize and backtest with software and get up with a very good or very bad result. For example, it gives you a very detailed so-called Excel to show that what is your potential profit, what is your maximum drawdowns, how much money you lose basically, your Sharpie ratio, and for past 10 years, this data, how many trades you'll be going in, and how many percent is actually profitable. You see that it's almost nowhere for you to come up with a very good system and able to trade quite a lot. So but at least it gives you a very positive idea of how this may be performed for the past 10 years. But it doesn't guarantee you what will actually happen for the next 10 years unless you go through another test called for test, paper test, or you put your real money to test it. On the next slide, you can see that it even go into details. Every single entry price, you can calculate your slippage if you want to put in. Where is your potential profit, and loss and all this? Where is your biggest winning trade and all this? So you can even put a analysis or choose the type of so-called result, okay, to show you what period, every year, whether by using this system, whether it works or not. You look at this Excel, you can see that first year lose 5%, second year make 4%, then lose 6%, 2%, and a windfall on the fifth year you make 25%, and so on and so forth. So it looks like a good system, but you don't make money every year. So you add all this, then you have to make a call whether you should practice with this indicator. And if you're wrong, you'll be wrong for the next 10 years. So this is how, at least this kind of software will save you time rather than believe in someone that tell you these are the best indicator and you do it with your real money. at least you put in the data to test whether it's actually suitable for you in trading or in your futures trading. So with this, we go into another topic which just as big as this, but we have only 10 minutes left. So the fundamental analysis. Fundamental is actually very important, but as I said, it becomes less important. Depends on how you look at it. Let's say, for example, my view on trading with stock will be, you need to look at fundamental, but you need to pick up the technical signal for entry and exit signal. Then only you look at fundamental for, whether this supports the idea. So same thing happens to futures. Is any sound foundation in technical analysis, and a trader should actually you look at the fundamental as well, because the fundamental explains the current stage of the market and why the market is moving like this. Sometimes there's no explanation, but that's why it doesn't make sense. But doesn't make sense or crazy, anything you want to name it, doesn't mean that the trend doesn't move in this direction, because there's always some reason behind this. And fundamental are the initial driver for any trend, because basically I believe in fundamental. In fact, I trade with fundamental for the futures, but then in different way of looking at the market lah. And the fundamental actually represent a global money flow, for country to country, from one commodity to another commodity. Let's say, for example, last time everybody trading gold. Now nobody trade gold because everybody trading Bitcoin, right? So there's something like that. When bean oil is so expensive, trader may be buying palm oil. When palm oil is too expensive, they'll be selling palm oil and buy bean oil. So there's money, from one commodity to another commodity and one currency to another currency. For example, ringgit, why is low? Because people selling ringgit and buy US dollar. So that's how the whole money idea works in trading or futures. So the factor like inflation, interest rate, and so on, is actually all these are summed up in the fundamental economy of a country, because that is actually how you look at a country is doing well or not doing well in this issue. And similar to stocks or securities, fundamental analysis in futures contract is actually as important. In fact, as I said, I always actually look at fundamental in my trading as well. But I don't really like, you see this result or this data, then you should trade this way. No, but it gives you some comfort. It gives you some confirmation whether your view is correct. If you have a very correct fundamental view, then you can assume this could be correct for you yourself. So fundamental takes longer time to see the result, but of course it's not 10 years lah. That means you don't have to wait 10 years to see that your trading result is actually work. I always say that if your trading tools, instrument setup is actually correct, your trading experience is actually enough, you should see your trading result almost instantaneously. That means if you trade for 1 month, you should see a very positive result, or at least you know that you could actually trading this way. You don't have to wait 10 years before to conclude that this trading method actually suitable or correct or not. But it could be very complex and subjective, because anybody has got interpretation for any fundamental data. So for example, fundamental analysis may consist of the demand and supply, which is the fundamental of all price action. Second, it could be the financial futures, which is the outlook of financial market. Because if you see FPI is going up, that means the stock market is actually going well, right? If you see commodity futures, CPO go up, that means the demand is actually high. If the price come down because the supply is actually, could be either the supply is actually high or the demand is actually very low. So either way, it's all about fundamental analysis. So the fundamental analysis, you should look at this angle, the demand and supply. This is just a summary. That means if you're not so sure how to look at FKI, you're not so sure how to look at CPO or any commodity, gold, look at the supply and demand. If supply is actually increased, okay, the price actually could go down. If the demand actually increase, the price could go up. So, and vice versa. So this is how things goes. But beside this supply and demand, you should also look at another factor if you're trading palm oil, which is seasonal pattern. So there's 4 seasons in the weather, but not in Malaysia. So, but Malaysia, most of the palm oil traded, is actually looking at Malaysian palm oil price or futures price for benchmark price discovery. So do you know that actually this crude palm oil, actually they have their seasonal pattern? Okay, I did a very simple test using palm oil price. You can look at here. Almost every December, November, October, the price tends to close higher, green color. And from May to September, the price tends to actually go lower. Not every year, but statistically, high chance the CPU price will go lower. So with this, you can actually look at, this is actually a CPU seasonal pattern. Sometimes you can actually apply this seasonal pattern into your futures analysis. That means you use the fundamental data to combine with your technical analysis. It actually boosts your result. Let me show you one of the analysis that I'm done. This is a computer simulated trade. If I apply a seasonal pattern into my trading of palm oil, it's actually yield a better or much better result if you apply in it. So this is actually one of the way you can actually try to improve. But of course, the more you improve, the more you optimize, then you fall into back to a trap called, over optimized curve fitting. So you see, trading, could be very difficult because if you move one side, then it's actually you lost the other side. So whether you want to look at pure price action, or you want to add indicators, or you want to add a lot of fundamental elements, but then over optimize will give you a not consistent result, because it gives you a very bad impression that things go this way, but actually you over optimize or curve fitting your result. So with that, slightly on the computer simulated trades, we go into some basic that you need to know. Let's say if you're trading FKLI, you need to know the GDP. Every year we have the GDP. We have the money supply numbers comes up from our bank Negara, our CPI, which is the inflation rate, our PDI, PPIs, which is the cost of manufacturing, all this. So this, if you look at the FKLI financial futures, you have to relate this. So how to relate this is you have to jot down all these numbers. So whenever these numbers comes up, good or bad, how it affects your price. So the impact of the news and data on the market, if you jot it down, then it gives you a very good idea whether you can trade with news and fundamental information. So no one actually can give you a very clear-cut direction, say if A equal to B, then you should do C. But if you jot down all this into Excel, for example, you have a very good track and practice so that you know next time when this happens, what is the likelihood of the next trend. So, but of course, the news on data on the market price is actually, we say is that the price discounts everything. So the market prices already actually reflect the total knowledge and expectation of all investors. That means anything you see in the price is actually result of all the news and data. So sometimes if you don't read the news data, it's okay, because the price is actually same information, but it's whether you know how to interpret it. And the often, the news and data release result in a very fast and rapid rate increase in volatility, but most of the time the effect is actually very short-lived. Sometimes you see a very big counter trend. That means a news announced, price drop 5%. The next second you see that it actually recover and then go up 2%. So this kind of we call counter trend or rapid or spike. You have to be careful, because this could be just, I don't know, it could be arbitraging, it could be a spread market widen, due to someone hedge their side that caused this price to go haywire. So you have to be aware of this as well. Don't simply just go in the direction that you think is actually correct, unless you prepare if you're wrong. I always prepare I'm wrong when I go into a position. So that's why I could actually go in either direction, because futures, the good thing about futures is you can go in either direction. But the good thing about trading is once it's wrong, then it's very fun. You have to play all these kind of rules, or the mechanism in your trading to make sure that you actually comes out alive or make some money. On the third note is sometimes it forms a counter trend. The data or the news cause a counter trend and cause a lot of traders to lose money. You know that the market should go up, but then suddenly you buy, the price come down, then you cut loss, the price actually resume the uptrend. So these are the things that happens impacted by news and data. So you have to be careful. News doesn't mean that you cannot interpret the news directly, because that is actually very risky. And the fourth one is actually economy and fundamental has a long-term progressing effect. That means it should not actually affect the market so fast. But then news, rumors, yes. So actual fundamental and economy should be gradually. And the last one is, of course, is not least, is do not try to overreact to any news and data unnecessarily, because the result is actually definitely not good. If you trade with impulse, most likely you get a very bad result in long run. You may actually get a good result once or twice, but it doesn't give you long run benefit. For me, most of my trade is actually plain trade. That means I could be park my orders at certain level, and I could park my sell order at certain level. So I actually trade with my rules and all my stuff is actually ready. That means if you look at my trade, most of my trade tomorrow, let's say for example, I already parked today. That means I roughly know where I want to buy and sell. I maybe adjust my price a bit, when the price it's not in my favor, or I can get a better price, I may adjust a bit. But honestly, I parked my price today already for my next trading session. So with this, probably I pass back my control to Shane, because we can go into the Q&A session from now. Shane?
Yep. Can you hear me?
Yeah.
Okay, excellent. Thank you so much, CC. Now we are coming back to the Q&A sessions, and I'm taking back the control. Okay, can you all see my screen now? Can you all see my screen now? CC, can you see my screen?
Yes, I can see.
Okay, excellent. So I have a number of questions here. So if you have any question you want to ask CC in regards to technical analysis on futures or fundamental analysis on futures, you may type it here. Yeah, so the first question is, CC, do you actually rely on, in TA, actually, do you rely more on chart pattern or candlestick pattern or the indicators? Which one constitute how many % of your trading decisions?
Honest question, very little. What I look at most is actually we call tape reading, which means I read in the numbers. I read, let's say, for example, just now there's 5 people buy at the price of 2, then price of 3, there's 500 people buying, and price of 4, there's 500 people are selling at this price. I look more on this kind of pattern we call tape reading. It's not even a chart yet, it's just a raw data, which is every tick, we call tick data, every second, not second, every single trade actually. So that's what I look at most. But then I also have plot a chart. I don't mind to share. I'm using a 5-minute chart using this Heikin Ashi as my primary technical tool.
Yeah, Heikin Ashi lah.
Yes.
But just now you didn't teach us about the tick reading lah.
Because that's really not in the technical analysis. So
Okay.
it's more on the raw data of prices lah. But
Okay.
I actually recommend you to look at this as well lah.
Okay, maybe next year. Okay, now how many of you want to learn this? Maybe you can comment. You can go to chat box and say yes. Okay, you type yes. Then if there's enough yes, then we can invite CC Yong and come back and share with us how to do tick reading. Okay. All right. So next question is, how do you calculate the risk to reward ratio? Do you use TA or FA?
Risk and rewards ratio probably is not what I do for my trading most of the time. Basically, what I'm it's more important to me in my trading or the type of trading that I'm doing is uh, where is my winning ratio? How many percent of winning ratio that I'm actually going to achieve for the past 10 or 100 trades, and that's why I project my future trades will meet. The risk and reward ratio, I could be getting very worse, like 1 to 1. That means I risk 1 ringgit for 1 ringgit gain at times. But then usually most of my so-called trades is um, 1 to, I don't say 1 to, because my downside may be very high, because I could be still looking at 1 to 1. But if you take into the winning ratio perspective, I could be achieve something like 1 to 3 or more. But then honestly, my trades, I don't look at the risk and reward ratio in my trade, but I rather look at my past hundreds or thousand winning ratio, because the way I'm trading, I don't really trade with a long trend. I do have position that overnight, that keep, probably few weeks, but most of my trade is actually quite short term one, and I don't really rely on trend. That means the instrument I'm trading actually more like sideways. It's actually, we don't call it directionless, but by nature it doesn't have a direction. That means I prefer a sideways market actually. That means I don't look for a trend market, because trend market is so difficult to look for. So that's why I look for sideways markets. That means I'm trading a sideways market rather than a trend market. When a trend market occur, normally I am the one who against most of the counterparty lah. So that means when a lot of people buying, most likely I'm the one who actually selling. So this is the kind of trades that I'm doing. It could be slightly different from general trader, but that's the most common type of trading that in our line. That means all the locals, a lot of professional traders are adopting this kind of strategy actually.
Mm, okay. Yeah. So next question is, where do you find the data for fundamental analysis?
Okay, I'm trading primarily on Malaysian crude palm oil. So my data is actually, I rely on MPOB. MPOB has got a data announced every number 10 of the month. So it's a summary of last month demand, supply, and all this. But every 5 days, the survey company will also announce some data and on the exports as well. Normally, you don't have to look for it, because you can actually contact your broker. Your broker is the one who can provide you this information instantaneously. That means whenever this survey company has got the data, or any survey done by Bloomberg or Reuters, they will actually send to you instantly. So you actually need to rely on your broker to give you the first, or you don't need the first information, but it gives you an idea where is the export or the fundamental data you look at. But besides that, other data like inflation rate, M2, all this actually will be announced in the news. You can actually read the news or the newspaper actually.
I see. Just now there were at least 10 years who want to learn from you how to do tick reading. So yeah,
Okay.
so yeah, it looks like we have to get you back already. So can you tell us what is Monte Carlo backtesting?
Interesting term, but I've done something on this lah. But basically, there's a few things you can done. Basically, you randomize all the data, you randomize all the criteria, you challenge your own system. That means you can develop your own system, and then instead of you use a system with backtest data 10 years, I've seen someone or a fund actually, they use 10 years backtest data and then they set up fund and they start trading with this kind of method and the fund fail actually. So the Monte Carlo is actually give you an idea to test whether the system actually really work as you wanted, or whether it can go through we call a stress test before you roll this system into the actual production. That means before you actually have a very good robust system that go through all the tests, there are also forward tests. There are also other names, to randomize all this, whether you can get a very good result from the system. I even backtest my winning ratios with this Monte Carlo system, so that let's say how many percent of winning rate I need in order to trade and make money in a long run. So that's why I just share to you, I have a system that designed to fail 25% of the time, which means I'm actually correct 50 plus 25 lah. That means 50 is default, you always correct 50%. I actually gain an extra 25%, but I give up 25% as I could be wrong. So I design my system such a way it meets the 25% of the time it could fail, it may fail, and then that is actually from computer generated. And then normally what I do is I use in all my trading, I record all my trading records, and then I calculate, let's say for the past 100 trades, how many trades I'm actually correct and how many times I'm actually wrong. I should actually to see that I could be meeting 25% of my trades could be wrong. If if I'm actually better than this, then I should be able to make slightly more money than I actually projected to. This is how you can find in all these kind of random tests to your system. All these random tests is actually good because if you my philosophy of trading is I always trade to an unknown. That means I don't project or forecast where the market go up or down tomorrow. Whenever I go in the market, I know that I'm trading with this setup, but the result could be very random. It could be I'm wrong or could be I'm correct. But I just want that when I'm wrong, I able to take profit as planned. And if I'm correct, if I'm wrong, I'm able to limit my damage by escape from these wrong trades and try to meet the 25% of time I'm still wrong or less. The lesser is better, of course, in this case. And this Monte Carlo will actually give you a very, very good picture of whether anything you learn, anything you heard from people, whether it works or not, put in the real test. But before put in real test, put in this test first. If this test also cannot pass, you can actually save the money and don't trade the system actually. Don't trade this way, basically.
Okay. Can you tell us what is the best time frame to intraday trade of both KLC, FKLI, and FCPO?
Okay, time frame in terms of chart, I'm using 5-minute chart. You can go as extreme as 1 or even a thick chart. But I realized that actually you can fix a time, which usually 5 minutes is actually enough for intraday. In fact, for intraday, we go in and go out. If possible, of course, if I can buy and sell in the next second and make money, I'll be happy to complete my trade. But I could be sometimes looking, I may be buy in the morning and in the afternoon, I maybe only sell and make some money, So to me, the time frame for intraday will be as fast as possible. But if you look at chart time frame per se, you can use 5 minutes as a baseline.
5 minutes. Now for beginners, especially for people who are new to technical trading, the question is knowing Heikin Ashi is enough, or we still have to learn other indicators like MACD, RSI, So to avoid being overwhelmed, so like what are some new indicators that for beginners to learn and then to master, and any good websites that you can recommend? So that's the question.
Okay, it's actually a nice question. But don't say your question is actually for beginner, because there's no beginner, intermediate, and advanced actually lah. Because all the questions is actually good question, especially if you really ask, because it's important for me to, as a speaker, to answer you from my perspective. I'm a trader. I'm actually trading for a living, right? So what I do is actually I make sure that I can take up some money every day, so or in a month, as my salary. To answer your question, is actually a very serious question. You'll be shocked if I tell you I only use Heikin Ashi. So the webinar that I'm showing to you is actually, that's what I'm using, because it's enough for my trading. It actually give me a job, with this Heikin Ashi. I don't really look at too many indicators, especially the complex one. So I'm look at this Heikin Ashi and some support and resistance. Support and resistance, you have to define yourself, right? So by looking at this and combine the tip within the prices, how many people park at what price, how many orders have been done in these prices, is enough for me to go into the market day in day out and try to make a living out of it. So to answer you honestly, I would say Heiken actually good enough, and that's all you needed.
Okay.
But if you can actually venture into more lah, but I recommend you to test with software first.
Okay, interesting. Now, Heikin Ashi is also something that I'm not familiar with. The other indicators I am fairly familiar. Lah. So this is the one that I should study more. Lah. Of course, if you can guide me, that would be excellent. But just when you mentioned about support and resistance, right? My question to you is, how reliable is support and resistance on a 5-minute time frame? Lah?
Okay. If you come back to my view or methodology on the market, is always wrong 25% of the time. So I would say this is what I'm looking at from my perspective. To me, actually, I don't rely on 100%. I always allow my trades to be wrong 25% of the time. So just to make it easy, I would say the support resistance is actually only reliable for 75% of the time only, actually.
Yeah, because my experience is that a support resistance work better on a longer time frame than a shorter time frame. Lah. Yeah, that's my experience. I'm
Correct.
not sure yours. I
It's
usually look
actually
at the bigger
because
time frame to find what are the key
uh,
support, key resistance. Then I only go to the shorter time frame I trade. That's my preference.
yes, that's why I mentioned that the support and resistance actually are discretionary by the technician. That means everyone has got a different view on the support and resistance, whether it works, by this time frame and all. So I would say, but the difficult part of support and resistance, from my point of view, is I can't test it. It's so difficult for me to test a support resistance by throwing 100 different instruments for the past 10 years and give me a statistic. So it's hard for me to give you a very clear statistics on how many percent. But as I say, anything to me is actually not more than 25%. I mean, not more than 75% is actually a good rate. To me, 75% is the Monte Carlo result that I actually looking for. That means anything that can pass that 75%, I'm good to go. Actually, I'm good to put in the money, to test whether this system will work in long run.
Okay. So the next question is, CC, as mentioned, just now you talk about tape reading, right? Like when we come to a particular stock counter, there are market makers who create this kind of volume. So how do you make such a decisions on this kind of reading?
Again, I heard the term market maker again. It's quite funny. A lot of people will ask me about market maker. Actually, for stocks, I'm not sure they still need a market maker. If the stock, let's say for example, Maybank, CIMB, which established stock, some new, let's say Boron or Coron, there may be a market maker. But there's no market maker in TPO. There's no market maker in FKI. So there's you can say that the prices in the tape reading is as reliable as you see. That means 100 people buying is actually exactly 100 people are buying. But you may actually notice, sometimes this price has got only 5 lots there, but once I hit the price 10 lots, it comes up 100 lots, at behind the scene. So, or I'm the one who queue first in the price, but suddenly someone actually got my price in front of me. I'm the first one to park at this price, but someone got the price in front of me. So it must be a market maker or some trader that behind my scene. First, the market maker is actually don't do any hanky panky thing to exploit the retail or any trader, because all your trades is actually monitored by Bursa and SC. We know this because we go through all the programs before we become a local participant. I can tell you, actually, most of the time you can see this kind of trades. You feel like it's funny and hanky panky because it's actually there's another trade happens concurrent with any KI or FCPU that you are trading is spread trading. Those spread traders are the one who actually park this price, and it seems like very funny because they park a lot of buy at a certain level and a lot of sell at certain level, and the price can come in and goes very fast pace. It's actually not the case. This is we call implied price. There's a spread trader trying to capture the spread prices, or they're doing rollovers, which they actually never trying to interfere the directional or trend market that you are trading with. But actually they are trading just different way, hedges and all these kind of method they're using. So there's no market maker trying to exploit the so-called general trader. If there's one, definitely they will get caught by SC and Bursa in no time.
Okay. Now, besides Ninja Trader, can you recommend other free charting software that we can use?
I actually only know Ninja Trader that allow me to download and test my data. So others, I'm not sure. I think that there's a few that, but I'm not sure whether it's freely to download and so on. So I only familiar with Ninja Trader as for now.
Okay. So is Heikin Ashi also take into consideration of price and volume?
You can, but I don't. In fact, Heikin Ashi, you can just look at it because sometimes if you look at Heikin Ashi, you can see that in the candlestick it shows that the price actually reversed already, but Heikin Ashi still show you the trend continues. So in this perspective, I will say that if you use Heikin Ashi, just go ahead and use the chart enough. Not really need to look at volume, because if you interpret candlesticks, sometimes if the volume is low, your candlestick become very odd, right? But the Heikin Ashi actually can overcome this by doing the average, so that you get a very smooth chart patterns compared to candlestick alone. So the answer is no. You can actually use Heikin Ashi as it is.
Okay. Now, CC, just like I mentioned about spread trading, I remember you have an event coming up, right? On Bursa Marketplace.
Oh, yeah. Next week we will have 2 events for Bursa Marketplace. You can check out the Bursa Marketplace website. 2 events for next week, which is on the Saturday. We have a event. Seminars in Bursa itself.
That they can join. Is it for free?
Yes, it's free. It's sponsored by our broker, so it's actually you can free to join.
Live session, you can.
One webinar and one one webinar and one
live session. You can meet CC in person, okay, and ask him any question they have, because there are still some questions on the ISC, but we are not able to finish all. But no worries. Thank you so much for everybody's time. But thank you so much, CC. And I have a that comes to the end of our Q&A sessions, and we have another events that we open for university students. So if you're online today and you are university students, I want to encourage you to join our FIFA Trading Challenge. Okay, so what is FIFA? FIFA is Futures is for All Trading Challenge. It's open to university students only. So if you are working adults, I'm sorry, you're not eligible to join. But if you are university students, whether you are from a private university or public university, you may join. Right? You just go to this link, http colon and then big.do/futures is for all, and then to find out more information. This is futures in this FIFA Trend Challenge. You will experience how you will go through a future simulation game when you will experience how to trade futures, and we have amazing prizes in store for you. The program is sponsored by Bursa Malaysia Derivative. We also provide food as well. So yeah, please come. This is a 2-day program to teach you the basic of futures, to experience the fun and excitement in trading futures. All right, you need to bring along your laptop to participate in it. So you can come in a group of 5 person to join this competition. All right, this trading challenge. With that, we have come to the end of the the webinar today. I want to take this opportunity to thank all of you for coming to our webinar number 6. Now, some of you here, I notice your name is very familiar. That means you have attended many times, and thank you for being our loyal supporter to our Bursa Malaysia Derivative webinar. And we want to express our profuse gratitude to you for continuously to learn from us, from our different speakers. All right. So with that, thank you so much, CC, for coming to support us in this and sharing your idea with us. With that, thank you everybody, and have a pleasant evening to all of you.
All right, thanks, Shane.
Yeah, thank you. If you, I will type the link for you if you want to see the link.
Oh, I just captured it, so okay.
Yeah, no, I mean, I want to share the link with all the participants for the FIFA Trading Challenge. Okay, with that, thank you everybody. You can go to the chat box and see the link. All right, with that, thank you everybody, and have a pleasant evening. Bye bye.